get to the word on Wall Street. Top investors watching your money. And joining me right now is the Bear Traps Report founder, Larry McDonald. Larry, good to see you. Thank you so much for being here. And you've wanted to own hard assets for a long time, and you've owned some equities in that space. What's your take on where oil is and how you want to invest around that?
Well, one interesting thing is the coal names, because of the disruption in the Middle East, the coal equities are actually up quite a bit. They're destroying the Mag 7 this year. So there's the KOAL ETF, or Core Natural Resources, are ways that we're seeing institutional clients playing this disruption.
Okay, but there's been, you said, a disruption in the AI trade. You know,
yes.
I mean, obviously, look at these markets, and growth was leading. What's your take on what's going on with regard to these AI stocks?
If you are a Mag 7 chief investment officer, or I should say chief financial officer in the Valley, right? You just saw your memory costs go up almost 100%. Your energy costs are up a lot. And now data centers are being attacked in the Middle East. So there's massive disruption coming at data centers, artificial intelligence. In other words, the street was expecting 820 data centers to be built over the next 5 years. Those costs have even gone up even more. And right now we have the testosterone fight in the Valley. Everyone's trying to outspend each other, but those spending budgets just went up another 20, 30% with what just happened. So that's going to cause some disruption in the AI build-out trade coming at us over the next several months.
No, we also had this speculation and worry that some of the smaller guys who are spending money on AI are borrowing the money, and maybe the banks would be held, holding the bag. You were negative on financials the last time we spoke. What's your take on that worry and this new worry that is emerging about, obviously, private credit?
That's the thing about this 2026 off-ramp that the White House is trying to execute versus the 2025. This time, we're coming into a real credit crisis driven by artificial intelligence, software disruption, and, like you said, the financing for AI, which was already at crazy levels. And so the banks, it's just the banks, it's private credit, it's the gating, and it's very much like 2007, 2008. It's not as bad, but the bottom line is the Trump team, when we come out of this on the off-ramp, we're coming into tighter financial conditions and a real credit crisis, which is eventually going to force the Fed to cut rates, not hike.
Well, that's the thing. I mean, the conversation has shifted because of what we heard from the Bank of England last week, right? And then now they're talking about interest rate hikes. But I spoke with Mickey Bowman. She's still expecting cuts. Look at yields this morning on the 10-year. The yield, Goldman Sachs is raising the risk of a U.S. recession, as you said. Now they say it's a 30% chance over the next year because of the spike in oil prices and these tighter financial conditions. The yield on the 10-year right now, up 2 1/3 basis points at 4.37%. Here's Mickey Bowman with me, the Vice Chairman of the Federal Reserve. She joined me on Friday. Watch.
Well, I've written in 3 cuts, and it's the same as last year. So before the end of the year, a lot can happen. It's too soon to tell what the impacts of Iran and the conflict may be, but I do expect that we'll start to see some of the supply side policies working their way through the economy, as well as the 75 basis points of cuts that we put in place last year.
So what do you think, Larry McDonald?
Maria, if you lived through the 80s and the 90s, what we saw over and over again is oil shocks and hard asset shocks, inflation, triggering a consumer slowdown, recession. This is the same repeat of like 1970s, 1980s, where we have this hit to consumption because of the tax that comes from energy. And that slows things down. That's why the perception originally, right out of the gate, is, oh my God, they're going to hike rates. But like Mickey said, the probability of rate cuts is going to really start to skyrocket.
So what do you want to do then as an investor? I mean, you want to short this market now and then get into it, or you want to set yourself up for rate cuts and a turn in this market later in the year?
The 2-year Treasury yields just went up a lot. And so that's what Stan Druckenmiller is probably doing right now, the legend. He's probably buying 2s because that's a bet on rate cuts, and they've been hammered the last week or two. The other thing is just looking at gold miners, hard assets, commodities that have been hit. Look at copper names; they're all down.
Look what happened to gold in the last 2 weeks.
That's right. But that's the whole disruption because of what we call diesel costs. that's pushing down the value of gold miners. It creates, like, we're off 30% on Hecla mining and a lot of these miners.
So you want to buy them?
Yeah, I want to buy the dip, absolutely.
What's your take on this speculation this morning about Jefferies? Japan's SMFG exploring a potential acquisition of Jefferies. The stock weakness is the trigger. Stock is down 35 to 40% recently, and now people say it's a target. Your thoughts?
I find it fascinating that Jefferies credit default swaps are trading much wider than Goldman Sachs, whereas a year ago they were almost the same price. In other words, people are betting on default, even though it's a small bet. We're not at crisis levels, but that's part of the whole financial conditions. And I just want to remind people, back in 2008, we were supposed to have the Korea Development Bank buying Lehman. It's not the same thing, but it's amazing when banks get stressed, all of a sudden, here comes a white knight.
Well, look, SMFG, Japan's #2 bank, already owns 20% of Jefferies. The speculation is they're preparing a team to take it all. You lived through it all, and you wrote about it at Lehman Brothers, and you had a great book, and you got another one right now. Let's see what this one is. How to listen when markets speak. We talked about it over and over again. Thank you so much, Larry.
Thanks, Maria.
Good to see you.
Good to
Larry
see you.
McDonald. We'll be right back. Stay with us.